I came across this interesting blog post on the website of IMF, and this is an article related to geopolitics and how it's impacts the financial stability of the world, especially from a point of view of cross-border investment. We are living in times when countries are not ready to cooperate with each other on various matters. You see tension between US and China, but also tension between US and European Union, which historically were friends. But now you see tension between US and many countries within the European Union. Even the relationship between US and UK, which historically has been pretty good, is not so good in the recent times. And especially after Trump coming to power, geopolitics is going to play a vital role in the world of finance. And people who are working in the field of finance, they're always aware of the geopolitics, and the decisions are always taken through what could be the uncertainties in the global geopolitics in the future. But it will be more so important going after, right? Whether you work on the investment side or on the lending side in the field of finance, you always you always worry about the country risk, the risk involved in the country itself. But you rarely think about the risk stemming from restriction from other countries in a given country. For instance, if you want to invest in equity market in emerging countries such as in India or in South Africa or Brazil and Mexico, you probably care only about the geopolitics, or sorry, the politics in that particular country, and less about how the tension between Argentina and US or India and US would impact the equity market in that particular country. So but it's more so important nowadays, simply because of the first of all the nature of the financial market, because financial markets simply don't respond to the events in the domestic market, but also respond to the cross border in events. And that's exactly what happening currently, right? So wonderful article actually written about it. You see, it's written during the times of Russia and Ukraine war. It was written, I think, in the first quarter of 2023, where the researchers have discussed about the impact of geopolitics on capital allocation, and how that's going to impact not just the equity market but also the broader real economy in various shape and forms. You see a negative impact both on the investment side but also banking activities, but on the real economy as well. Overall cross-border economy get impacted, not just the country which is imposing tariffs and all, for example in this case US, but also the country which is getting impacted because of the tariff. So it's the both countries will get impacted. uh, a lot of people think that US is imposing tariffs on other countries, so US will be spared and all the growths will happen only in the US. But that's actually not true, because other countries will also start uh, increasing the tariffs. There will be a rebuttal from other countries, and that would result in a number of problems in the US economy as well. Quite likely, for instance, the inflation probably will stay for longer time, and it's not going to be 2% anytime soon, because of import and the new tariffs coming from China and few other countries who have increased the tariffs, because US has now increased the tariffs. So it's going to impact both markets, and because of that you see the investment activities to slow down. And if you see, this particular paragraph is actually quite good. You see, geopolitical tension threatens financial stability through financial channel, imposition of financial restrictions, tariffs for example, increase uncertainty, cross-border credit and investment outflow trigger an escalation of tension and increase banks debt rollover risk and funding cost. This is exactly the reason why you see in Europe, despite the European Commission of Banking (ECB), which is a regulator, who has already decreased the interest rate, but you see the mortgage rates haven't really come down simply because the funding cost hasn't really gone down. It's still quite the same, and it's still quite a big problem for most European banks. So, and the reason is simple. This very less confidence of investor in the real economy, simply because there's so much happening in geopolitics, and it's still quite uncertain as to what's going to happen to many of these economies if more restrictions will be in place, financial restrictions will be in place. So investors are not too sure. No money is coming, a funding cost of capital is higher, and that is escalating to, or that is going into the real economy as well. People are having tough time getting money at a decent rate for buying houses and so on, but also for businesses as well, right? Because they, especially the small businesses, they get impacted. It's also affect the equity market as well, the stock market as well, because if the real economy is not doing well, that will have an impact on the financial market, the stock market as well, right? Okay, it could drive up the interest rate on government bonds in reducing the value of banks' assets, adding to their funding cost. Um, Problems, uncertainties with global economy only drives up the return on safe assets such as government bonds, goals, it's commodity, and you have assets such as the crypto and so on. So these assets obviously do well, but equity market doesn't do well, and that gets impacted. At the same time, geopolitical tensions are transmitted to banks through real economy. The effect of disruption to supply chain and commodity market. This is important to know because of the restrictions you see. Uh, the commodity market, more recently, you see restriction on steel import, um, import on food grains, import on raw materials. If that gets impacted, that will add to the inflation, higher inflation for for many countries who rely on import. So that would result in you know problems in the domestic growth and with higher inflation. And if that happens, that would result in banks, market, and credit losses as well to various means. And that would obviously impact profitability and capitalization. And it will come back to financial market as well. I mean, the equity market will come down. If profitability goes down, so will be the value of companies, and therefore stock prices would also go down, right? So it's a double warming, not just to the real economy but also to the financial, to the equity market as well. The stress is likely to diminish the risk taking capability of banks, prompting them to cut lendings, right? And that would even have worse impact, because if the profitability of banks get impacted, they will cut down on funding. That will hamper the growth again, right? So it's a double warming to the economy, right? It's a huge problem, right? And it's not going to be just a problem for the emerging markets, the European Union or the UK or Mexico. These countries are now facing the brunt of restrictions put by the US, but even US itself will also face these issues because US also imports a number of things from various countries. And here is this graph between tensions and banks performance. You see emerging market, okay, the funding cost to one standard deviation increase. Okay, the advanced economy get impacted bit less, but the emerging market, for them to sort of win the trust of the investors is always a challenge. The banks in the emerging markets, and as you expect, the funding cost get impacted hugely because this is a standard deviation. How much standard deviation? The cost of capital get impacted because of the geopolitical risk. Advanced economies are obviously somewhat less impacted, but for now, because after Trump has come, even the advanced economies in the Europe will get impacted, and this probably will be much higher now. All right, amazing read. If you really want to read, I will put that in the comment section. So the conclusion here is that geopolitical risk is not good for anything actually. It's not just good for capital market, but it's also not good for the overall economy. And banks primarily get impacted. And if banks get impacted, then the whole economy get impacted.